please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Well, as expected, RBI kept key policy rates unchanged, but with warnings on inflation, crude oil prices and fiscal deficit, the RBI made it clear that it does have its finger on the trigger for a future rate hike. We spoke to a whole host of experts on the issue, and here is what they had to say.
I think the reason that inflation forecast didn't change is because there's just so much uncertainty around two key variables: oil prices, which the MPC says can move in both directions, and minimum support in price increases, for which we don't know very much. So I think given the quantum of uncertainty at this point in time, they chose to stick to their baseline inflation path and simply pointed to risks.
So one of the big question marks was on the resolution of some of these large assets which were there. And if you see, some of these assets actually are in investment mode, in the sense that the capacities are not fully utilized, purely because they require some private investment that needs to be put into them. And the benefit of that surely will be taken by the new buyers who will come in. So once, I guess, we come into that stage, which is not very far off, the private investment will surely be there, and that is I'm quite optimistic on that.
Reserve Bank's stance of taking a pause at this stage is very much expected. Obviously, there are upward pressures on prices, but still it is well within the range of the inflation targeting framework that you have. In December, there was, the inflation rate was almost more than 5%, but nevertheless, sort of it is well within the 6% range that you this thing. Ultimately, what happens in future will be data driven.
Around the monetary policy, there was always an expectation that there should be a cut. There should be a cut, and RBI has always been telling that let's wait for more data, be data dependent. Now, when the situation is reversed and we all get impatient that why there is not a hike, so I think it makes sense to wait for some more time. The only thing I would like to mention, if we read the current statement, there are 6 upside risks which RBI has listed, which all of them appear to be very formidable and kind of sticking, whereas some mitigants are mentioned which may not be so strong. So I think the thing to watch is going forward whether the problem is getting a structural nature or it will remain transient.
All right, so that's what all the experts made of what the MPC did yesterday. But now we have the editor's take. Lata Venkatesh joins us to take us through her analysis of the monetary policy decision, what it could mean for the markets. Lata, the finger on the trigger has been put, but has the aim been taken, and are they ready to fire?
On the contrary, I think the finger's removed.
Oh, okay.
Look at the way the yields fell yesterday. Yields fell by about 10 basis points, right. Both the 10-year paper and, of course, across the yield curve. What the governor actually said yesterday is that inflation will be 5.1% for this quarter, Jan-March. It will be 5.6% from April to October. And only after that, after October, there is a dip towards 4.6. And all this does not include the MSP possible rise, any possible move in petroleum, the fiscal deficit impact, the rise in duties, announced customs duties. All that is not yet factored in. So clearly, you're guiding for an inflation above 5%. Your mandate is 4%, and you are not hiking. So the message was clearly dovish, but it's a great masterstroke. The yields are already at 7. See, the aim of the RBI is that the difference between inflation and the yield should be 150 basis points. Right. It's already that level. Because of Viral Acharya's strong talk, it has already, the yields have jumped. So I don't have to hike rates. My purpose is achieved because of the yields. And therefore, he talked dovish yesterday. Yields have fallen back. They may not fall much more. Now, I think they will take cues from the fact that US yields have surged, but crude has fallen. So now it completely becomes a play of other forces. But the overall impact of the policy is actually dovish. That doesn't take away the other big problem that public sector banks are not buying. Yesterday or day before, PNB results, 1,100 crores was treasury losses, mark-to-market provisioning. So they are in no mood to buy, because the more they buy, every additional bond appears to be a reason to provide. So there are no buyers, but there are no supply. There is no supply also. At the moment, the government borrowing program is over. So till April 1st, we won't have a problem. It's a truce. There are no buyers, but there is no supply. After April, when the new supply comes, what happens, we don't know. Until then, yields are going to be on this level, soft side, and largely dance to global cues. Just very quickly, the impact on stock markets. The fall in yield is obviously positive for NBFCs. There is also the rule which they are enforcing, which they announced long back, that foreign banks with more than 20 branches will have to follow priority sector rules like Indian banks, which means they have to give more loans to farmers, marginal farmers, and MSMEs. They had a forbearance there. So MFIs and NBFCs will benefit, because these three banks, HSBC, Citi and Stancy, will have to buy loans from them. They don't have the branches to access, so they will have to buy. And thirdly, the banks have been told that your base rate, you are not bringing it down every time you bring down the MCLR. Now we will harmonize the two. So they will be forced to bring down base rate, which means they will lose a bit on margins. Today, that would be minorly negative for banks. That's why banks fell actually yesterday in the last 5 minutes or half an hour. Nifty Bank fell because this base rate pressure will be there.
Okay, Lata.